What's up, guys? It's Cashflow Cart, and I'm back with another video. If you're new to my channel, I just want to introduce myself. I'm a 22-year-old. I'm a dividend growth investor. I love to build passive income using some dividend investing strategies, and the majority of my videos are going to focus on different strategies and my own personal philosophies for how I've built my portfolio, lessons I've learned, and my journey. But with all that being said, I wanted to do a more fun video today, and I'm going to react to some comments on the dividends Reddit thread because, I don't know if you guys are on Reddit too often, but sometimes in class, I just like to get on Reddit, read comments, waste time basically. If I see something interesting, I'll screenshot it. And today I was like, I might as well film a video with all these dumb screenshots. So here we go. Let's get into it. Okay, first up, is the strategy in this video normal or worth trying? And Dap the Genius said, watched a video and he essentially buys these dividend stocks: Procter and Gamble, JP Morgan Chase, Home Depot, Coke, Apple, AbbVie, Kraft, VOO, and Johnson and Johnson. And he's asking if this is a good strategy for dividend investing. And I see this and I really think about a common mistake that a lot of new investors make, and they try to find what are the perfect dividend stocks. What stocks need to make up my portfolio. But with that being said, they don't take into account one of the other most important factors in being successful in this game, and that is valuation. So you can love a company like Johnson and Johnson or Coke, any of these on the list. You can love the company. You can see that they have a wide economic moat, and that doesn't mean their stock is necessarily trading at an attractive valuation. So I guess my problem with this one is it suggests that, these 9 securities, I guess 8 stocks in an ETF, you put your money in equally weighted. And the problem with that is, guys, some of these could be trading at a relative overvaluation, and that's going to be discouraging if you kind of get in at a top per se. So I hope I'm explaining this well, but in my case, I like to look for value within the dividend growth or within the dividend growth universe of stocks, if you will. So again, none of these are bad companies, but I think this guy is forgetting that the valuation you pay for a stock is going to have a huge effect on, how it serves your portfolio, your yield on cost. Hey, go away. Let's move on. Next up. Oh, that was a response. Question about day trading dividend stocks. I read that you only need to hold a stock for 2 days before its dividend date to get paid the dividend. And this guy is referencing like the ex-dividend date per se. So you have to have a stock for a certain amount of time, set by the company before the dividend for you to actually be eligible to get that income into your account, which that is true. Why is it not a common strategy to buy up a lot of dividend paying stocks 2 days before its payout date, and then after getting paid the dividend, sell all the stock? Is this not a good money making strategy? And I think this is kind of a phase every dividend investor starting out goes through, where they think that, holding these over time really serves no value, and they can kind of just jump around and collect dividends on different stocks throughout the year. And to answer this question, I guess, the day the dividend is paid out to you as a shareholder, the stock is going to open adjusted down to an equal amount of that dividend. And essentially what this does is protect against, this dividend arbitrage that this guy is kind of describing here. So the short answer is no, you cannot do this. So yeah, that adjustment down does not mean something materially has changed with the company. It's simply to prevent, this kind of strategy from, I guess, being effective. Let's move on. This one's not on the dividend thread, but I guess we will react to it. And it was on Wall Street Bets, which is, kind of a goofy subreddit, I guess, but sometimes it's funny to look at. This guy said, war portfolios, how do you navigate global conflict as an investor? And he said, hey, all, the world seems to be rapidly going to blank in a handbasket, taking my portfolio along with it. I think we all agree that the war stinks, but given the current macro situation, I'm trying to mitigate. You get the gist. So this guy's kind of talking about, what you should do in response to different news, different things, world events happening. And for me, I can say I've found it best. I've found it most effective to not worry about external factors. I mean, there's going to be, right now interest rates are high. There could be, war going on in other countries. And a lot of that, guys, I mean, while it affects the stock market, a lot of that's going to be noise and it's going to distract you from your overall goal of creating this portfolio that generates income. What I would look at something like this is, an event that can create buying opportunities. So I'm always trying to take what the market gives me. I'm trying to find which stocks are undervalued that I'm interested in owning in my portfolio. And again, I'd rather be buying dips and averaging into companies rather than trying to sell, realize gains. I just want to buy so I can, compound my dividend income. So try not to let external events make you panic, I guess is the bottom line here. Mia, be quiet. Sorry, guys. I have a Boston Terrier, and sometimes she gets fired up whenever I try to film videos for some unknown reason. Okay, these two kind of go together. This next comment on the dividends subreddit, how much money did you guys have invested before you really saw the snowball effect? He said, got a bit over 1,500 invested, going slow but consistent. Curious when you saw the snowballing. And guys, what this commenter here is kind of referring to is, when do you really start to get a sense of, okay, this is working in my portfolio? That's the snowball. As the snowball rolls, it gets bigger, whatever. If you guys like sledding, you've probably done this before. So that dividend snowball, for me, when I saw it in my portfolio, was when, okay, there's some months, maybe I don't have as much net new capital to invest into my portfolio to buy my dividend stocks. I really saw that snowball when my dividend income month to month started to surpass what I could actively invest, new capital. All right. I hope that made sense. But, with that being said, guys, I don't use some dividend reinvestment plan. All my dividends that come in each month, with the exception of maybe a few withdrawals here and there, I'm putting towards my best ideas. Okay. I'm beefing up smaller positions that are still at an attractive valuation. Or again, maybe I'm even starting new positions. And I saw that snowball, it really hit me when my dividend income some months would be greater than money I could invest. That's pretty cool to be able to build your portfolio without having to, deposit money all the time. And, I advocate for both reinvested dividends and new capital, but, we're normal people. I understand it's going to be hard sometimes to invest a meaningful portion of your paycheck. So that's when I saw the snowball effect. Moving on. To everyone who doesn't drip, what do you use your dividend income on? And I think I kind of just answered this one. Drip here referring to a dividend reinvestment plan. So me personally, I don't drip because I'm so focused on, getting good values on the companies I buy. And if you do, like, you drip, essentially what that's going to do is slowly drive up your cost basis. You're going to get a lower starting yield on these dripped shares. Mia, you got to be quiet. So, so yeah, I take all my dividend income and I'm putting it back into, whatever I find attractive in the current market. I take what the market gives me. Moving on. You gotta be quiet. Sorry about that. This one I think is very interesting because, I'm obviously a young dividend investor. I think dividend investing is amazing at any age, whether you're in retirement and using dividends to supplement your income or even fund your lifestyle. That's great. Or if you're younger and you want to invest in dividends, just to see that compounding and to see that, passive income start to stack up. I think either way is great. I don't think there's a wrong time in life to be a dividend investor. However, I think this guy's making the mistake of, you know, the stock market only goes up, that classic, assumption. And that is not generally the case. I mean, over long time periods, the stock market can go up. I guess historically it has. But, just in 2000, we saw the dot-com bubble, and it was a long time before the market was actually able to make new highs. Yeah, guys. And again, like I said, really with that value investor type mindset I bring to the table here, I can still get capital appreciation on my dividend positions. I would go for it like a total return kind of a hybrid method. And yeah, I will say this. If you're young and investing, that's great for you. You're already doing a great thing. You've got a lot to learn, but it's a pretty amazing journey. And I will say, seeing your passive income, start to pile up, start to compound is one of the most motivating things as a dividend investor. And for me, it's been the strategy that I've seen work best because I can get that total return, I can get that passive income. And yeah, I'm not afraid to be a dividend investor in really any market conditions. So I hope that answers that. I just thought this one was funny, quite honestly. Market will likely chop up and down the next 10 to 15 years. I mean, that's a first off, that's a pretty big claim to just make. But he said dividends will be the best bet. And I want to address this by saying, and this kind of goes with the last point, as a dividend investor, we don't know what the market's going to do, guys. In the grand scheme of things, no one knows what the market's going to do. People on Wall Street, they don't know. They kind of create this groupthink mindset, and sometimes their predictions or fair values can come true for certain companies, but guys, they're always reacting to the news. And just like individual investors, there's not some secret edge where one person knows what the market's going to do for the next 10 to 15 years. I guess my reaction to this one is I really don't care because, again, I'm searching for those undervalued dividend growers. And as they kind of come back to their fair value, regardless of what the market's doing, I should be able to lock in that starting yield and I should be able to get those capital appreciation. I should be able to get that capital appreciation. And, I couldn't be happier with that, guys. I love watching my passive income month to month grow. I don't know. I feel like I'm repeating myself, but like I said, this has been a very rewarding journey, and I hope you guys will enjoy this someday as much as me. Another one from Wall Street Bets. We'll probably skip over this pretty fast. Last 35K left and looking for strategies to 10X in a short time. I guess I just thought this was funny. I don't know that I have some genius reaction to this, but moving on. Okay, this one did spark some, opinions for me personally. And this person said, when will SCHD start growing again? And I think this is kind of a common, a blanket thing. People just want to plug SCHD into every hole. And it's like, they're almost forgetting that SCHD is essentially a portfolio of around 100 companies. Sometimes it's got 104. And people are like, talking about SCHD should be 40 to 60% of your portfolio. And then these same people can't even really tell you any of the holdings in SCHD. So, I'm not on here to hate on the ETF SCHD, but I will say, kind of thinking that it's some fix all problems type of solution. It's just not the case, guys. And it will start growing again when the underlying holdings, there's 104 companies in that ETF. When those 104 companies start growing again, SCHD is going to start growing again, right, guys? I mean, it's not going to trade perfectly at its net asset value just because of, supply and demand, different stuff. But essentially, SCHD is going to move with its holdings, about equally weighted. And I don't know. I just feel like people throw SCHD at everything. And I'm honestly kind of tired of it. Yeah. Sorry, guys. My dog has decided she wants to play. This is her. This is Mia. Want to say something? Okay, I guess not. Moving on. Are you dollar cost averaging any dividend stocks? And I like this question because, dollar cost averaging is kind of something that's talked about a lot. It's some phenomena in investing. And I'll put it this way. I understand when you start a position, for a lot of us in this kind of accumulation phase, it's not very practical to just start with some lump sum amount. So we're kind of going to be dollar cost averaging as we build our positions out, if that makes sense. And for me, I will dollar cost average while a company is at an attractive valuation. So I'm not going to just pick one company that I'm just going to dollar cost average into forever. I'm going to pick maybe something from my watch list that becomes, okay, now this one's attractive to me. So I'll build the position. I'll dollar cost average when I can with dividend income and net new capital. And as I kind of build out that position, in a perfect world, I'll kind of average through the bottom, if that makes sense. But I guess my answer to this one is no. There's not one specific name that I'm interested in just dollar cost averaging in till the end of time. Let's move on. I don't want to spend too much time here beating a dead horse about the drip thing, but I think this guy brought up a good point. Sometimes if you are dripping shares, not only are you going to get in at maybe a valuation that's not as attractive to you anymore, but sometimes your fills on those drip shares, your fills are going to be maybe higher than the market price. So, it's really going to drive up your cost basis like we talked about. And again, I don't want to beat a dead horse, but I personally do not drip. MMM 3M. Okay. MMM is looking promising. I know, guys. I see it. You see it. Everyone has kind of been starting to look at 3M again. The valuation's been beaten down because of all the earplug drama, all the lawsuits with veterans. I don't know if you guys have looked into this or researched it much, but basically what you need to know is 3M's facing a lot of lawsuits, and it's made the starting dividend yield as well as the valuation, pretty attractive, I guess, for long-term investors. If you believe a giant company like 3M can kind of weather this storm. I'll say what I'm kind of doing here. Right now, I'm definitely on the sidelines with 3M, and, not to say that you shouldn't buy it right now or anything, but for my own personal risk tolerance, I do kind of want to see, some sort of resolution here before I, start pouring money into this. I think that's going to come in early December. They've got some hearings, I guess, starting. So again, I'm on the sideline for this one right now. Not to say I won't revisit it, but yeah, do your own research, guys. If it's attractive to you, by all means. But for me personally, it's not not the best opportunity right now. And then this one I saw today. Anyone else just getting absolutely crushed this week? And I thought this kind of was a little bit ironic, being in the dividends thread on Reddit. He goes on down 1.1% today, down 2% past week, 4% past month. And I'll put it this way, as a dividend investor, guys, after you've been doing it for a little while, you kind of disconnect from, okay, what's your total portfolio value? And you more just trust that over time you'll see it growing. But if I'm down on a position, that is, for me, that's by no means a red flag. That's just, okay, I've got more time to build this position out. I'm okay with averaging down if I believe in the company. I think it's a high quality stock. And, if I'm going to buy it at 39, we'll take Pfizer, for example. If I'm going to buy it at 39, I'm buying it at 37, buying it at 35, and then now it's at 31. Guess what? That's an opportunity for me to buy more, to get, a higher starting yield on that position and to bring down my cost basis. So again, that was a quick disclaimer. I am long Pfizer. I am currently down on my shares, as I guess probably everyone is who started a position in Pfizer in the past few months. But again, as you get more into this dividend investing game, you'll kind of disconnect if your portfolio is down, X percent. You'll more just focus on, over time, my portfolio values increasing as these positions appreciate. But more importantly, my dividend income is increasing. And again, so I wanted to include this one. Let's see. Is there anything else? Apparently, there is no other comments that I wanted to react to. So we will wrap this up. Like I said, guys, today was more of a fun video. I haven't made any content like this, so I hope this casual format was okay. But if you want to see any more of my content where I go over, my philosophies more in detail, I'm going to have new content coming out on Monday nights and Thursday nights. I'm going to try to stick to that schedule with the 2 uploads a week. That should allow me to keep the quality of the content at the place I want it to be at. If you enjoyed this video and want to learn more about dividend investing and building passive income, feel free to subscribe, guys. If not, have a great rest of your day, and thanks for joining me.